Welcome to the Building and Growing podcast. We're delighted to welcome Enis Hulli back to the Building and Growing podcast. Welcome back.
Thanks a lot for inviting me, man. It's great to be here.
You're most welcome. We're in the London studio, the home studio now.
It's the first time I've ever had something like this. It's amazing. I need something like this, actually. I can, do a lot of content with this.
Yeah, that's it, mate. And look, the last one we did was an absolute banger. And so I'm sure, we'll do the same this time, even though
Fingers crossed.
That's it. But it's kind of the opposite of what we did last time. So the sort of the contrast is going to be interesting.
Exactly. So, I want to touch base on what we talked about last time as well, just to, reiterate it. And then we can talk about emerging market investing, which is fun stuff.
Yeah, that's it. Well, look, Enis, why don't we kick off? Do you want to do an intro to yourself and, 500 Emerging Europe? And feel free, I guess, to recap on what we covered last time. I'll hand it over to you.
Of course. Thanks a lot. So I'm the general partner of 500 Emerging Europe. We're a 70 million euro fund covering the Baltics, Eastern Europe, and Turkey. And the whole thesis of the fund since our start back in 2016 has been to bridge companies to more mature technology markets where they can get early adopters with high enterprise budgets. Given that the majority of our fund is B2B technology companies, they actually need these early adopters who are playing with new and upcoming technologies, and hopefully once these technologies become more mature and penetrate into everyday life, then these companies will be well positioned to leverage on that, making sure that they get positioned at the right timing. So going to the US, being able to sell in the UK or in these Western markets have been critical for us, basically. With that thesis, we've invested into close to 70 companies by now, around Eastern Europe, the Baltics, and Turkey. So our whole emerging market thesis has been invest into the talent, which is in Eastern Europe and Turkey, but then hedge against everything else. Revenue must be from Western Europe or the US. Fundraising, Series A, B, C, all the way till IPO and M&A, again, has to be from Western Europe, UK, or the US, which is in some ways similar to other emerging markets, but in many ways a complete contrast and opposite to what other emerging market investors that are operating in places like LATAM, Southeast Asia, Africa, MENA, etc. do, which is what we're going to talk about.
Fantastic. And so I know that before we started recording, we were talking about how some of 500's, I suppose, branches invest in emerging markets themselves, whereas you guys are more focused on, I suppose, extracting the talent. But, do you want to dive further into what you guys are doing, given that we'll focus on the other parts of the fund later on?
I'd love to. If you look into our Fund 1, which is now a mature fund because it's 7 years old, we have 28 active portfolio companies, 3 of which became unicorns, and then 2 companies that are 100 million plus. Nice. Actually, one of them operating here in the UK, fintech company called Plum.
Okay. I know.
Which is also a good example of like having the technology team back in Greece, but targeting the UK market from the start. Yeah. So out of these 28 companies, the total revenue is more than $600 million, out of which I'd say not even 1% comes from the Baltics, Eastern Europe, or Turkey, which shows this technology export vision that these founders have set forth. And then if you look at the total employee count, there's about 3,000 employees in these companies, out of which I would say 1,500 of them are technology teams, out of which 70% are based in Eastern Europe and Turkey, again, showing how they're banking on the local talent that's prevalent in these different markets, which is very different than what a fund in LATAM or Southeast Asia or MENA or Africa does. There you have to take a big bet on the local value chain, meaning local talent operating either in the local market or expanding regionally, of course, and then making sure that you're able to find downstream capital to be able to become the unicorn of MENA, unicorn of Southeast Asia, etc. And if you look into different 500 funds, 500 has more than 50 unicorns in its portfolio, out of which I would say probably more than half are non-US companies. And if you dive deeper into those non-US companies, you would see that these are companies who either started in Brazil, expanded in LATAM, started in Dubai, expanded into a billion people population around MENA, etc. And it's a core thesis for a lot of the emerging market VC funds, just not for us. I think emerging Europe, which is what we call the region, the Baltics, Eastern Europe, and Turkey, has these weird dynamics where it's not actually a region. It's 20 countries with different languages, different currencies, different geopolitical situations. None of these markets are venturable in and of themselves because they're not big enough, which means that all these big companies, all these big technology companies need to have a day one US or Western Europe. It doesn't have to be Western Europe. Let's call it a mature technology market focus to become unicorns. And out of the 35 companies actually that became unicorns from this region, almost all of them had global presence from day one.
Okay, fantastic. Well, look, we dived into a lot there. So I guess let me try and summarize it. I suppose the companies that you're investing in, they are going for the populations of Western Europe and the US, and essentially hard currencies from day one, with maybe some cost base denominated in local currency from the regions that they emerge from. Whereas some of the other funds, are going to be local currency denominated from day one, and those local currencies and markets that they're expanding to are very, very large. I mean, I think Latin America and Southeast Asia both have similar population sizes, and then if you look at the Middle East and Africa, that's a huge, huge region as well.
Exactly. And if you look at historical emerging market investing, whether that's private equities, public equities, etc., you would see similar dynamics where being local or being from that region becomes a moat in and of itself.
Yeah.
And then funds want to basically leverage that, make sure that they bet on the winner who's going to penetrate the market, because there's much less competition in any vertical compared to the US, for an example. And in these markets, also capital becomes a moat in and of itself. And if you're the leading company that's able to get access to that liquidity, because there's illiquidity in those markets, that would, mean that you would be the front runner in whatever vertical that you're targeting. And this has been the case even before technology investing in emerging markets, and I think it still is the case in technology investing.
Yeah, indeed. I mean, you look at a few super app examples, you got Rappi in Latin America. If we go across Turkey, you've got Getir, Southeast Asia, Grab and Gojek. Certainly these are players who managed to raise a decent chunk of capital and build up, I suppose, their market
Exactly.
share.
And it's funny because a lot of the examples you just gave are hyper-local examples, meaning the demand is local, the supply is local, the operation happens locally, which means it's very tough to scale, but at the same time, being local becomes your competitive advantage, which is why when Uber expanded into the Middle East, they got beaten by Careem. When they expanded into Southeast Asia, they got beaten by Grab or Didi in China or 99 in Brazil, which shows how your being local becomes the core competitive advantage, becomes the main bottleneck for your global competitor like Uber, who's trying to expand across these regions. So that model definitely works. I mean, there are these proven business models that have these hyper-local dynamics, not only on the operational layer, which are the examples that we give, but can also be regulatory, for an example, or fintech, obviously licensed businesses. And then you can, bank on that.
Yeah, indeed. Well, look, I mean, it'd be great to dive further into the emerging market type thesis. But before we do that, I want to see if there's anything else you want to touch upon about 500 Emerging Europe.
With 500 Emerging Europe, we still believe that this is not a region. We still believe path to becoming a large company, path to becoming a unicorn doesn't, there's no path of being successful in Turkey, then expanding into Romania, Bulgaria, and becoming this emerging European unicorn of the region. We still don't believe this exists.
Yeah.
We still believe that entrepreneurs need to start global from day one, start from the tip of the iceberg, tip of the pyramid, and then you can go down. You can go down in terms of segment, you can go down in terms of technology maturity. There are different ways to look about it. And I would say that over the next 2 years, we're probably going to invest another 50 million euros into the region with this thesis.
Yeah, fantastic. Well, look, there's a lot to look forward to there. I guess just another question from me in terms of when you're investing that, what stage and founder profile are you looking for?
Dude, I love pre-seed idea stage. Like, that's personally me speaking.
Yeah.
I love it, but you have to have a balanced portfolio. So I would say 50% of our portfolio is pre-seed idea stage. Sometimes founders are not even full-time yet when we commit, and then they quit their jobs and become full-time. So there's not even a desk and a computer, basically. There's just a founder who's still full-time at his or her previous job. That's 50% of the fund. The other 50% of the fund are more seed companies. They have a prototype or a working product and some sort of traction. This can be early users, early design partners, sometimes revenue, but rarely, to balance out the portfolio. And if you look into the types of companies in those two categories, pre-seed or seed, whenever it's a more of a blue ocean market where you want to take a lot of small bets into a market that's newly supposed to happen or come about, that's where you do a lot of pre-seed idea stage. If it's a bit more of an established markets where you can see the total, like where you can see TAM, SAM, SOM, and things like that, or look into the competitive landscape, etc., then you expect more. Because in those markets, sometimes the technology hurdle has also come down. The barrier of entry from a technological perspective has come down. So you at least expect the founders to, you know, have some sort of a prototype, validate how they're gonna differentiate, even if it's in its charity phase, which is the phase where, you know, they're actually they have users, but they're not charging them, etc. We call that the charity phase. But the more of a red ocean it gets, the more we do seed. The more blue ocean it gets, we're more comfortable doing idea, pre-seed, first check-in.
Fantastic. That's excellent. Enis, thanks so much for giving that overview of 500 emerging Europe. I want to dive into emerging markets and you know, loop back to Latin America because, you know, I guess my background's in fintech, and so that's always, I guess, the area that I feel safest in. Nubank was established a few years ago in Brazil, and you know, it's since listed on the New York Stock Exchange. It's one of the most highly valued fintechs in the world, but all of their revenues are, you know, in local currency. And so I want to start off with a really broad question to you. Why do investors choose to invest in emerging markets with local currency?
I think what triggers investors to start thinking about deploying more capital in the emerging markets is they feel like it's way too cheap than the risk that it entails. I think it being too cheap pushes them to invest, which I feel like is the wrong motivation, because there can be a lot of different motivations. Investors might want to invest into the emerging market because they feel like that market is going to grow rapidly. That might be one reason. They might want to invest into an emerging market because they feel like there's only going to be one winner in one category, and as long as they pick the right type of founder and be able to put enough capital behind it in a proven business model, there's going to be the winner anyways. Doesn't matter how big or small. All of those can be motivations, but I feel like what pushes them is the fact that they feel like there's this market asymmetry where things are valued a bit too low as opposed to the currency risks, geopolitical risks, or whatever risks that there are as a market sentiment. So it almost feels like they want to earn as they invest. You know, there's a saying where you either make money while you buy something, or you make money while you sell something, or both. These investors mostly want to make money while they're putting the money in at the first place, just because they feel it's too cheap. But for something to be too cheap, there needs to be a value attached to it anyways. There needs to be some traction, etc., which means a lot of the emerging market investors only want to invest into companies when they have traction, when they can see the metrics. They make sure that this company is the clear winner in whatever the space is. It's very tough for a new competition to come in if they put that Series A ticket or Series B ticket in. They have strong business fundamentals, and when they compare those strong business fundamentals to their US counter peers, for an example, they see that it's 1/5 the price. And it's just like too good to be true. And then they come in, which gives a big hole in pre-seed or seed investing, because global funds don't actually do pre-seed seed investing in emerging markets, but they want to come later on in Series A. But your Nubank is a good example of that. As far as I know, and correct me if I'm wrong, Nubank was the highest valued private company up until they went public, you know?
Yeah, I think so. I mean, they were, you know, certainly worth more than a lot of the banks in Latin America who, you know, may have offered more sophisticated, let's say, B2B services that really make a whole lot of money. But
probably worth more than all of the other neobanks in the whole world combined, if you reduce how much they've raised so far, bearing in mind that there's liquidation preferences on it anyways. For example, Revolut is huge, but how much they raise, or, you know, all of these companies, they almost raised as much as what they're valued now.
Yes. That's right. I mean, the interesting thing about you know, Nubank relative to, in my view, some of the fintechs in Europe, is that Nubank kind of created a market by banking the underbanked, banking people who had never had a bank account before, you know, so they just targeted the unbanked and the underbanked and then distributed so many different financial products to them.
And like, those should be the right motivations to invest into emerging markets. You would believe that there's either underbanked or unbanked population that can get the company from zero to millions of users pretty fast, and that opportunity in and of itself should push you to invest, you know? Unfortunately, especially in venture capital, because it's risky anyways and the horizons are long, you make returns in 5, 7, 10 years, I feel like that doesn't push enough investors to jump on board, but rather how cheap an opportunity is compared to the opportunities they see in the UK or the US push them to invest, you know?
Yes, yeah, indeed. And look, I mean, my maths might be wrong here, but in Southeast Asia and in Latin America, there's similar population sizes. I don't want to estimate the wrong estimate, but let's say 500 million in each. And so there is a huge population there, even if you consider the services or products that you might be able to distribute those populations are low value. It can still add up to really big numbers.
And it's really easy to become not easy, of course, nothing is in the world, but it's very easy for a market to have less competitive dynamics compared to the US or the UK, just because there's not enough VCs or investors who are trying to target the second largest or third largest or fourth largest.
Yes.
It almost seems like in emerging markets, everyone wants a chunk of the winner, which makes the winner go even bigger compared to the second runner-up.
Yes.
Whereas in the US or in more developed markets, if there's an Uber, there's a Lyft, and probably 10 other ones that tried. There's always a second, third, or fourth player where enough investors have taken their bets on that are competing, which pushes the leader not to have enough margins, try to squeeze them out, subsidize the market, etc., etc. Isn't the case with emerging markets? I mean, the winner, whoever raises the Series A or B becomes the clear winner, and there's no one else who is taking a big bet on the second, third, or fourth player.
Yes.
Which is bad for entrepreneurs, of course, but I think it's very attractive for investors.
Yeah. And look, that's a really good point, because when you talk about sort of winners in developed markets versus emerging markets, the question that it brings me to is, what type of yields do people expect in emerging markets relative to a developed market?
I think one thing that's been problematic about emerging markets and equities in general is the return profile and the yield matters a lot depending on when you exited.
Yes.
If you don't exit at the peak and you're in a downturn because of currency, geopolitical risks, illiquidity risks, or whatever the case may be, you would see a huge devaluation of your asset. Even in real estate, you would see a huge devaluation of your asset, which is not the case with markets with hard currencies. As long as obviously there's always cycles in every single market, but the volatility of the cycles are much deeper in emerging markets. Which brings it to the case where, like, if you look at a long enough horizon, I feel like Nasdaq beats every single public market.
Yeah.
So in other markets, to be able to meet Nasdaq, you have to know when to get in, when to get out, which again pushes investors to only get in if they feel it's too cheap to be true.
Yeah, indeed. And I think this is a really good sort of movement towards discussing the risks. And so I'm going to talk about the current cycle at the moment. We've got high interest rates in the US, in Europe. It often leads to devaluations of emerging market currencies. There's a lot of USD denominated debt in those markets. Does that create, let's say, the type of market conditions that investors would look at, companies and say, actually, the price earnings multiple here might be cheap relative to 2 or 3 years ago when interest rates were low in developed markets?
Unfortunately, not yet, but soon. I think venture needs a reset to be able to signal that. But because a lot of capital was raised in 2020, 2021, 2022, and then a lot of capital was raised on behalf of these large companies on those dates as well, they then did raise their extensions either last year or maybe sometime in 2023. I feel like by the end of 2024, two things are going to happen. A, these very large companies that raised at like large multiples in 2021, 2022 who probably got their extensions over the past year are going to be running out of their extensions as well. So we'll see big failures, consolidation, M&A, whatever the case may be. And then at the same time, we see funds that were raised in 2021, 2022. Right now, they're still carrying this baggage of having invested at the hype of the market. So to be able to have positive fund returns, no matter how small, but still needs to be positive, they're either not taking enough risks or deploying capital into their portfolio companies to, even out or average down their entry tickets, which they entered back then. But beginning of 2025 is when we're going to see a complete reset, and market conditions hopefully are going to, stabilize, not taking into account the 2021 market. Going back to your question on emerging markets, I still feel like how the interest rates have risen and how VC became a proximity-based business again, where it's just like 2017 or 18. If you want to raise from the US, you have to go to the US. Was the norm. And then it changed in 2020, post-COVID. Everything became very global. There was immense liquidity in the market, which pushed every investor to invest across every single region and geography, which meant that you can stay in Istanbul, stay in Budapest, stay in Bucharest, and, you know, become a unicorn, decacorn, be able to raise all that funding. I don't think that's going to be the case anymore. I think it's going to go back into being a proximity-based business, but we still haven't felt that reset yet.
And, you know, I think there are still companies who are, I guess, teetering on the edge. You know, I mean, WeWork being one example, I guess, where...
Are they still on the edge?
Yeah. Well, I mean, I guess they're kind of balancing off abseiling, but we're about to see whether, you know, they
Good
fall.
luck with that.
Yeah. I mean, I guess, today's 1st of November, and, you know, it'll be interesting to see a week from now how they're getting on. But, it's super interesting, particularly what you mentioned about, I suppose, if you want capital from the US, you're going to have to be on the ground there, which, you know, will be definitely very different compared to what we've seen over the past few years. So I want to just loop back to the risks, because we've discussed quite a few so far in passing. I'm wondering whether maybe we could do some like rapid fire definitions of different
Let's
risks.
do it.
So how about I'll call a couple out, and then you know, well, I'll call one out at a time, and then you do a definition, and then I'll go to the next one.
Okay.
Awesome. So let's start off with currency risk.
Good example. Subscription businesses. They're great, right? I mean, VCs love subscription businesses. The public markets love subscription businesses. It's very predictable.
Yes.
You can increase your MRR, control churn, have upsell, have net negative churn.
Yes.
You know, it's amazing stuff. But at the same time, subscription businesses in local currencies can bite you.
Indeed.
And one of our portfolio companies in Turkey, getting subscription from enterprise companies in Turkish lira.
Yes.
Even though they were increasing their customer base by 2x year over year for 2 consecutive years, which is good for a company in their size, their MRR was going down just because those subscriptions were in Turkish lira. That was conditioned to be increased by the rate of inflation, which was much lower than the actual devaluation of the currency.
Yeah.
So it was very tough to explain to investors why their MRR was not increasing, although, you know, that you can show payback, unit economics. It almost felt like math was wrong somewhere.
Yes.
It's not. It's just that subscription businesses can be very good where you don't have the currency risk, whereas a transactional business model might be better if you have the currency risk, because you can adjust the price accordingly almost on a daily basis.
Indeed.
which would impact you less, because depends on what your COGS is, but you can price it at least, and the market, you know, expects for you to price it. But currency risks are real. And I think it's less so in startups, because startups selling a software product that's hopefully a software product that's highly scalable, huge margins, etc.
Yes.
You can move your way around it. You can try to go to a different market compared to other equities, which are like private equity, for example, or public market investing. You would have these large companies who are doomed to sell in local markets, in local currencies, and it's very tough for them to a cross-geo sales team expansion. Perhaps even the market is too competitive. Not the case with startups. So long story short, although I think currency risks are definitely there, if you're going for an emerging market, every single emerging market has its own currency risk, and it's open to a lot of different externalities that might impact it. At least selling software means that you can move your way around it. It would hurt you, but you can, you know, at least be able to change the course of the ship.
Yeah, fantastic. Excellent example. Let's dive to the next one, political risk.
Political risks, I think political risks are very bad on 2 levels. And I think they're very bad on illiquidity, because a big problem is illiquidity in emerging markets.
Yeah.
And a lot of the times, capital runs away because of the political risks that they foresee. And it wasn't that great anyways. And now that the market is feeling that there are some more geopolitical risks or political risks, illiquidity shrinks even further. It's also a risk in terms of being able to get customers because of different election cycles or things that are happening within the region, conflicts, etc. Customers also go to a conservative mode, which is something that the Western markets don't. I mean, the Western markets saw that conservative mode at the beginning of COVID, where people didn't know what's going to happen, and then the same thing happened with the current downturn because everything was going down. People went into a conservative mode for like 1 or 2 quarters.
Yes.
But that's it. Those are very short times, short periods of like macro stuff happening. Whereas in emerging markets, you have that type of a cycle once every 1 or 2 years. You know, where the consumer or these enterprises where you're trying to get their budgets would feel threatened and scared for whatever reason they have, and would go to a conservative mode.
Indeed. Fantastic. How about regulatory risk?
I think a lot of emerging markets are bipolar when it comes to regulatory risks. There's regulatory risks in every single market. I mean, there's regulators that are making or killing startups in the US on a daily basis. But at least I feel like they never go from 0 to 1. It's more of a gradual increase where everyone expects something to happen. There are counter arguments around it, and a couple of regulations pass one by one, maybe making it more and more stricter to operate for startups. Those things happen. Yeah. Whereas in emerging markets, you would see no legal framework for a while, no regulatory framework, which doesn't mean you can operate, but it also doesn't mean you can't operate, which puts you on the gray zone, which might be good for the business, but it's very scary for a lot of investors because they don't know if it's black or white. Yes. And then it doesn't gradually become regulated. It becomes regulated overnight. So I think those risks are real, but again, not so much for startups. Yeah. I feel like as startups in emerging markets, especially software businesses in emerging markets, a lot of emerging markets are followers of regulation. So you can easily see what's happening in the West in more mature regulatory environments to understand how your country is going to behave, which makes it much more predictable than trying to create your own category in the US. Yeah,
indeed. And look, I mean, a lot of people might laugh when I say this, but I've heard Australia categorized in a way as an emerging market before because I guess 2 key drivers. First one is that because we export so many minerals and that, it means that like our currency cycles are the same as say Brazil and whatnot. We're very commodity driven in our exchange rate. And the second reason is because we just copy all the regulation from the US and the UK, which means that, you know, like with neobanks and stuff like that, it happened over in, you know, Europe and the US first and then Australia followed. So, it's interesting.
Some countries are able to counter-position themselves where they pass a very forward-looking, modern, liberal regulatory framework in a market where these more developed markets won't be able to do so. Lithuania is a good example of that. Estonia is a good example of that, where their regulatory frameworks, there's a bunch of different countries, by the way, that did this around crypto and blockchain as well. They're able to pass regulations that brings a big competitive advantage to the country itself.
Yeah, that's it. And look, I think, you know, certainly we saw that with Malta very early on. They introduced, you know, blockchain and crypto laws. I think Gibraltar did the same. Very interesting. And Enis, are there any other sort of risks that you would want to highlight? I know, you know, you touched upon liquidity before as well. But
that's the biggest one, I think, because I'm trying to understand the risks that are with emerging market investing in general compared to emerging market startup investing, right? Because that's the field that we're in. Obviously, all the risks are the same, but their weights are not the same. And I feel like the risk of illiquidity is the largest risk in emerging markets, because to be able to build something big, to be able to build something venturable, you need to be able to burn capital for 5-10 years, which means that you have to be able to raise that A round, B round, C round. And the moment you're not able to raise that, your growth stalls. You become a tech SME. You're not in that venturable value chain financing game anymore, which pushes you out of the market, and you basically become almost like a zombie startup. Yes, and it happens a lot, and it has a lot to do with illiquidity in the market more than anything else. There might be reasons of illiquidity, which might be currency, political risks, etc. But eventually, it is illiquidity, and I feel like what countries need to do in that case is, because it's very tough to manage the currency risk. It's very tough to be able to manage the geopolitical risk that is in your region. It's not that tough to manage the liquidity risk for startups, because we're not talking about that much of money. I mean, if you look into we see total amount of VC capital that's been poured into these emerging markets. And let's say that VC becomes a fully global game after Series B. What you're trying to do is you're trying to make sure that there's not that much illiquidity on pre-seed, seed, and Series A.
Yes.
And the total of that would be less than $1 billion for every single emerging market. I mean, pick an emerging market, it's less than $1 billion. And then compare that to the GDP of the country or the region. It's basically nothing. You know, it's very easy to smooth that illiquidity disadvantage out.
So illiquidity risk is a big risk. However, there are investors that are able to exit from their investments in emerging markets. So do you want to talk a bit about the exits?
Yeah, exits is a good issue. The reason why I talked a lot about downstream capital as opposed to exits is because that's what I live on a daily basis, right? I have 60 portfolio companies that we talk to on a daily basis who are trying to raise their A, B, and beyond.
Yes.
Exits are a big issue if you're not big enough in emerging markets. In the US or the UK, you become a 50 million company, a 100 million company, there's someone to buy you out. Whereas in emerging markets, there might not be a player who's willing to give that multiple to you or to acquire you, which again means that you become not a zombie company, but it's tough for an investor to get its returns.
Yeah.
If you're big enough, there's always an exit path. I think if you're big enough, there's always a global acquirer, there's always an IPO path. You can do a dual IPO. A lot of the local public markets are also getting, very, very, very good traction, including Turkish public market over the past 2-3 years. I mean, it's doing huge sums of returns. So that, I think, long story short, that M&A risk happens a lot in the mid-market level in emerging markets.
Yes.
And I think the core reason of that is the downstream liquidity risk. It's because these companies are not able to raise their Series A's or B's or C's properly is the reason why they become these mediocre successes, which then is tough to sell from an investor's perspective. But if you're able to make sure that these companies are going to get their Series A, B, or C's, then hopefully more of them are going to graduate to the next level, and then this illiquidity risk in terms of M&A almost erodes.
Yes, yeah, fantastic. Look, I mean, I wish I could find more sort of stories to read about people who have exited well from emerging markets. I'm sure they're out there. I'm just reading the wrong sort of literature,
Unfortunately, like in this mid-tier of like say 50 to 200 million exits, which happen on a daily basis in the US, but not so much in emerging markets. In the US, they say that companies are not sold, they're bought. It's the complete opposite for that segment in emerging markets. Like companies are not bought, they're sold, unfortunately. Yeah. And you'd see a lot of different middlemen or investors or founders themselves at that phase of their life cycle in the company where they're actively gauging and looking for buyers. And when you're in that position, it puts a big discount on you.
Yeah, indeed. I mean, I heard a term the other day, acqui-exit, acquisition exit, and it's a
sad term.
Yeah, someone's been bought out, but maybe they covered their loans that they had to pay to start the company and whatnot, and that's about it. They walk away with hard work and a few wrinkles.
Exactly. And if this illiquidity in M&A is in this mid-segment, that risk wasn't there in emerging markets, then there wouldn't be any risk investing into emerging markets, because when you invest into an emerging market, it's always 100% certainty that the company is going to grow.
Yeah.
It's very, very rarely where the company doesn't have positive unit economics, positive margins, or doesn't grow. It's 100% they grow. But the thing is, they're not able to become a massive success. And because our whole industry is power low returns, only maximizing the upside, etc., potentially you're not going to get that out of those companies, and that becomes their biggest disadvantage, their barrier, But if we were to make sure that these $50 to $100 million companies are going to be able to exit when the time comes, I think the return profile of emerging market investing would be very, very downside protected. Like there'd be almost no risks.
Yes, yeah, fantastic. And I think that's been a really good overview of the risks within emerging markets. I'm going to say one statement now before we go into sort of the final part of the podcast. But I remember when I moved to Turkey and joined Guess Here, people said to me like, oh yeah, they raised a lot of external capital, and this was relative to other companies in emerging markets, and this is going all the way back to sort of 2020. So they'd raised pre-COVID. And someone said to me, yeah, like if a company in an emerging market with local currency revenue raises, it means that, they must be profitable, or at least EBITDA profitable. And so, do you have any views on whether that's changed since, the pandemic?
Yeah, I wouldn't say profitable, but I would say they would have numbers that are too good to be true. The example that I gave you, the Turkish enterprise SaaS company that had the subscription revenue in Turkish liras, that's why it was going down.
Yeah.
But at the same time, they were able to grow their customer base. What happened with them is in that short period,
Yes.
they did have that downturn, and it did affect them.
Yeah.
But if you compare them to their competitors, they became the market leader by far. So what these emerging markets offer you is that with small sums of capital, you're able to achieve so much and grow so much. I mean, since then, they've again continued to grow their enterprise customer base, getting to almost 10x of what it was and becoming the clear leader in the market. So what, like with your example in Getir, I think investors either expect positive gross margin, both positive transactional revenue,
Yeah.
in these emerging markets, because they feel like Getir is the only player who's doing that anyways, which should entail that you should be able to get that positive gross margin.
Yes.
Or you should be the clear winner in that market, because it's not that it's supposed to be not that competitive.
Yeah.
Because if it is that competitive, then it's not worth it. That's the whole value of doing emerging market investment. There's not that many players doing it.
Indeed.
So I wouldn't say it's profitability. I would say it's more market penetration, growth levels, metrics that are too good to be true. I mean, some of our SaaS companies that are servicing emerging markets, and namely Turkey, would have payback periods, unit economics that are like too good to be true,
Yes.
You wouldn't see a company that's near it in the US, just given how hyper competitive it is.
Yeah, fantastic. Well, look, to close off, I guess, we've got two different types of audiences. Some who are interested in raising from emerging markets, and some who are interested in investing into emerging markets. So I was wondering if we could start with those who want to raise, if you've got any tips for them.
Unfortunately, I still believe that like pre-seed, seed is very, very hyper local. So what you have to do is you have to make sure that you're able to get someone on board that is in your local ecosystem. I wouldn't say this 2 years ago, because for a brief time frame, for a 12, 18 month time frame, it became global, where you'd see US funds, UK funds investing into wherever emerging market. Not the case anymore. So you need that local backing for sure. But after getting that local backing, it's easy to get some global investors on board, either some micro funds who are trying to do smaller tickets, some angels, etc., because they become your bridge to your next round of financing. You need those global signals as well on your cap table, basically. But after Series A and beyond, it becomes almost a global. Of course, there are some local funds, talk to them, great, but make sure that you're also tapping into either global funds that invest globally or US funds that are only doing emerging markets, because they exist.
Yes.
It's tougher to reach them because you're not based there, but then again, it's the founder's job to remove those obstacles, right? So Series A and beyond, we really push our founders to come spend time in London, New York, SF, where they can find these emerging market investors to do Series A and beyond.
Yeah, fantastic. And any tips for people who are interested in investing in emerging markets?
They should have long horizons. I mean, they shouldn't be afraid of certain short-sighted political, geopolitical, or currency issues, because this is a long game. And I feel like if you wait long enough of a horizon in emerging markets and you get that tide going up, you make massive profits.
Yeah.
So although it's more volatile compared to compared to developed markets, and when you enter and when you exit matters much more than developed markets. At the same time, given that with volatility, if you wait long enough, you do get that rising tide, basically lifts you up. And from that longer horizon of thinking of 5 or 10 year spreads, you shouldn't care that much about what's happening politically or economically or currency wise in that emerging market, if you're mandated to do so.
Yeah, fantastic. Look, this has been one of my favorite podcasts, I suspect. So, Enis, thank you for everything that you've covered there. Before we wrap up, is there anything else that you wanted to dive into?
Not really. I just feel like this emerging market investing thesis is very, very strong, and at the same time, there's not enough VC funds that are executing on that.
Yeah.
The way we do emerging Europe covering 20 countries, the way 500 does pre-seed, seed, LATAM, MENA, Southeast Asia, Africa, etc., I feel like there needs to be more global funds with people and partners in these 5, 6, 7 emerging markets around the globe doing Series A, B, C tickets. And these are going to happen over the next decade or so. I just feel like there's not enough of them.
Indeed. Well, hopefully, it means that you guys can keep sweeping up in the meantime.
I hope so. I mean, I hate it. I like doing pre-seed seed, but at the same time, it would be fun to try that out,
Indeed. Enis, thank you so much, mate, and look forward to having you back again soon.
Likewise, man. Thanks a lot for having me.
You're most welcome.